Welcome to the Essential Tax Podcast with your host, Mishkin Santa. In each episode, we'll take the complex world of tax, all the jargon, acronyms, and stuff that make your eyes glaze over, and explain it in an impactful way to understand the complex and unknown areas. You can find this show on all the major platforms, including YouTube, LinkedIn, Apple Podcasts, Spotify, and on our website, thewolfgroup.com. Now, here's the host of Essential Tax Podcast, Mishkin Santa.
Hi, everybody. Welcome to the podcast. Today is going to be a solo podcast with me. I'm going to be doing the September tax update. We've got some really great updates for you from different countries, such as Australia, Brazil, France, Spain, and Switzerland. We've got some updates on digital assets, FBAR litigation, obviously some IRS news, and a brand new U.S. Social Security agreement that is now or looks to be put in place in 2025. And then some state tax updates. We'll sprinkle those in from California, D.C., Maryland, Massachusetts, and New York. And then before the end of the calendar year, I'm going to try to do updates for October, November, December. I may try to lump all those in together into one podcast, though, maybe call it a partial Q4 update for everybody. A lot of moving parts going on right now, so we want to make sure we cover everything through the end of the year. And with that being said, let's get rolling. So our first topic for today is Australia. So Australia, back on September 24th, they have a treasury law amendment bill that basically says that they're going to increase a withholding tax. So if you're a non-Australian person and you own Australian real property, if you sell it, there's a withholding tax, at least before this bill was introduced, of 12.5%, and there's a cap on what it would apply to. Under this bill that was announced on September 24th, the withholding tax would increase to 15% and the cap would be removed. So basically, it doesn't really matter what the value would be for the property sold in Australia, the 15% withholding tax would apply. I didn't read the bill thoroughly, but my assumption is the withholding tax applies to the sales price. It seems to mimic very closely the U.S. law, which is called FBAR. FBAR has the same kind of withholding tax. When a non-U.S. person owns U.S. real property, there can be a withholding tax on the sales price of 10% or 15%. So it seems like this law is kind of mimicking what we have here in the U.S. And the policy decisions behind this new proposal is that real estate prices and valuations have increased in Australia significantly, obviously with inflation across the world. And then with what the U.S. did, this is way back in the 1980s when the U.S. introduced the FBAR. This obviously supports the collection of income tax liabilities and also provides an incentive for non-Australians to file and get their withholding tax back if they're due it back. So if you're a non-Australian person and you hold Australian real property and you plan on selling it, just be aware that you may have some issues related to withholding tax. That is the summary or the moral of that story. Moving on to Brazil. Brazil has a couple new things that are in play. There's an update on the Brazilian inheritance tax. And then Brazil, which is very well known for having different types of amnesty programs, has a brand new amnesty program in play. So let's talk first about the Brazilian inheritance tax. So this was approved in August and now is in the Brazilian Senate, my understanding. It's called Projeto de Lei 108/24. Excuse my Portuguese there. I'm probably not very good on the Portuguese. But basically, it's proposing a reform to the inheritance tax, which is currently at 8%. However, they're going to change the rates. We don't know what the rates are going to be yet, but they're going to do it more like the U.S. estate tax, where it would be based on progressive tax rates. So a certain bucket would be taxed at X, a certain bucket would be taxed at Y, et cetera, et cetera. And then two new changes. In Brazil, there are a slew of different types of pensions, but in particular, there are two pensions that this would then apply to. The first is called PGBL, and it would apply to PGBL. So, for example, if I owned a PGBL pension and I passed away and that went on to my heir, then the inheritance tax would apply to the full amount of PGBL. The second type of pension, which is called the VGBL, The tax would only apply to contributions made by the owner 5 years prior to death. So any contributions made within 5 years of death would be subject to the inheritance tax. Okay. And then the second thing that's kind of going on in Brazil, this came out on September 16th, 2024. There's a brand new amnesty program. So, and it applies to both residents and non-residents. And basically, if there's any kind of income or financial assets that have not been disclosed, you have until December 15th, 2024 to disclose the assets that were not disclosed prior to the end of 2023. And there's the deal is that there's going to be reduced tax and penalties and no criminal prosecution. And I believe there's going to be an implementation of a 15% capital gains tax and then a penalty of 100% of whatever that tax is. So there's the trade-off there. And so potentially if you are someone that has these issues and the trade-off works to your favor and maybe you want to avoid criminal prosecution, you might want to look into that amnesty program before the end of the calendar year for Brazil. Okay, moving on. Let's go to the state of California. So the state of California on September 13th, and there's a slew of these things that are happening in California. This is just an example of one of them. But this I think applies to a lot of service providers. So for example, the Wolf Group, we provide services to California-based residents. So this would potentially apply to us, although I don't think it would apply because I don't think we have more than 250 customers in California. But let's just walk through this real quick. So there's a notice of proposed rulemaking on September 13th that would basically amend the state of California's market-based rules for how it apportions income. And it would affect asset management services, sales of professional services. So we're talking about CPAs, lawyers, doctors, et cetera, sales of intangibles and sales of services to U.S. government. So potentially, that could pull, those types of sales into California and make those taxable in California. For professional service providers, though, the proposed rulemaking basically said you have to serve 250 or more customers. And what that really means, like how you track that and how that works, I think needs to be determined further. But we got to keep a close eye on the change to the market-based rules in California. Apparently, if this goes through, this would be applicable starting back on January 1st, 2024. So the start date, could already be in play for this type of rule change. Okay, the next topic that I want to talk about is digital assets. And when I say digital assets, that is a term that is now a catch-all for anything related to cryptocurrency, Bitcoin, NFTs, whatever you want to call it. It all now goes into one big kind of general description called digital assets. And we have a very, very interesting case that was decided, or basically the defendant, Frank Richard Algren III, pled guilty on September 12th. This individual is from Austin, Texas. And this is an interesting one because this individual underreported capital gains from the sale of about $3.7 million in Bitcoin in 2017. So Frank sold Bitcoin in 2017 for $3.7 million and failed to pay $550,000 in tax. He pled guilty to that, and that is a very interesting issue. I would dare to say that we'll probably see more of these types of cases being presented as time moves on. The IRS has a very good kind of approach to how to deal with digital asset taxation. Now, their way of keeping records is a little questionable, and kind of how that will work moving forward. We'll talk about that here in a little bit. But I would tell anyone that has unreported income from digital assets, you probably want to try to come forward, maybe do some kind of voluntary disclosure before you get caught up in the same net that Frank got caught up in. Okay, the second item under digital assets is a case called Harper versus Werfel on September 24th. And basically what happened is that the IRS issued a John Doe summons to Coinbase in 2016, trying to mine for information related to transactions that occurred between 2013 and 2015. And in that, Harper basically says you can't just issue a broad John Doe summons to obtain this information. You have to directly identify the individual people that you're looking to go after. It can't just be kind of a quote unquote witch hunt. That's a violation of the 4th and 5th Amendments, as well as third-party summons law. And the First Circuit basically dismissed all of Harper's complaints. So basically, this kind of gives the IRS back, or I don't think they ever lost the power to do John Doe summons, but it kind of reaffirms their ability to do those summons for cases like this, where the IRS can kind of do a broad net and then pull as many people into that as possible. Speaking of the instructions, I talked about this earlier. There's been a lot of commentary on the Form 1099, the new Form 1099-DA. That has been sitting out there along with the draft instructions. There was recent commentary from individuals reviewing those instructions in September, saying that there's a lot of language inconsistencies specifically related to the reporting of sales or exchanges of digital assets held by investment trusts. So the IRS has kind of taken that into account, and I think we'll be updating the form to accommodate for that. The GAO also issued a report on September 19th, and it indicated that there's some confusion between what goes on Form 1099-K versus what goes on Form 1099-DA, and that they're going to try to put out more guidance and outreach related to those, what goes where and how those two forms work in conjunction and coordination with each other. So this is an area that I would tell a lot of CPAs, you've got to start learning how the Form 1099-DA works, because you're going to see it. It's going to come very soon. And there's going to be coordination with other various forms and parts of the tax return. And if you don't know how it works, you could improperly report something for one of your clients. So be very, very careful in this area. The last item for digital assets are some changes to the voluntary disclosure program. And there's been a lot of movement related to voluntary disclosure lately. There's been some publications recently about how voluntary disclosure has worked, how stringent it's gotten, how many bad outcomes have come through that. I've maintained for the longest time that when history kind of looks back on the offshore voluntary disclosure period from, call it, 2009 to 2018, the IRS will have a black eye for the way that they kind of approached doing that service or that program. And honestly, I think it's one of the areas where there needs to be some kind of regulation. I think we need voluntary disclosure regulations put into play. I think there could be a lot of challenges here to the program. But hopefully it's not something that will do away with streamlined filing, because I think those are really good programs that a lot of taxpayers use. But to speak directly about the digital assets and voluntary disclosure, there is a form called the Form 14457. And basically, it's kind of a pre-clearance form. You got to fill it out to be able to get into the program. And there's a new version that came out in September that's got a lot of feathers ruffled, if you will. And basically, the new version, when it comes to digital assets or cryptocurrency, wants to know, quote unquote, all domestic and foreign digital asset transactions related to tax non-compliance during the disclosure period. That's a lot to give up front to the IRS just to kind of get access to the program. And it's also a very detailed, you have to basically have all of your ducks in a row and ready to go before you start to work on this form. And you have to be okay with giving all that up front to the IRS through the form. So that's an interesting take, that normally you would do that on the back end once you get into the program. But that's a very interesting kind of, we want it up front before we let you in kind of take from the IRS. Okay, we're going to go back to the states, but instead of the state, we're going to talk about the District of Columbia. District of Columbia, DC, has got two kind of new updates. They're not earth-shattering by any means. But what a lot of my clients never take into account for estate tax planning purposes is that some of these states have their own state estate tax. So if we look at clients that we generally serve in the Virginia, Maryland, DC area, Virginia does not have a state estate tax, but both Maryland and DC do. And so DC has announced that in 2025, the exemption amount for the DC estate tax will be $4.9 million. And there will also be an additional unified credit of $1.9 million. So basically, you'd have to have a little bit over $7 million worth of assets before the DC estate tax kicks in. Additionally, DC announced a new refundable child tax credit that won't be for the 2024 tax return, but rather for the 2025 tax return. It is $420 per qualifying child who has not reached the age of 6, with a maximum of 3 potential qualifying children on the DC tax return. So there may be some more relief for families that have young children. I think there's some income limitation thresholds there, but for the most part, if you have young children and you live in DC, you could get a refundable credit that could help out starting in 2025. Okay, moving on, we've got FBAR litigation. So there are two different cases that I want to mention here today. The first is an update case. This is the Schwarzbaum case. This one's been going on for forever. I've been monitoring this for a very long time. Really interesting case. And basically, this case is getting into the Eighth Amendment, which a lot of people don't. If you ask a lot of people what the Eighth Amendment is, they probably wouldn't know. But it's the excessive fines amendment. You can't have excessive fines or penalties. And so that's been argued in the First Circuit. The First Circuit said, no, FBAR penalties don't fall under the Eighth Amendment. You can give as many FBAR penalties as you want to when they're not considered excessive. We now have a split. The 11th Circuit said, well, wait a minute, we think they are subject to the Eighth Amendment. And so there's a strong possibility here that now that we have a split between the 11th Circuit and the First Circuit, that we could have a Supreme Court case on our hands related to the Eighth Amendment, which for those Supreme Court buffs and nuts out there, they will really love getting their hands into this one should it go into the Supreme Court. I will remind everyone, or for those that don't know, that Schwarzbaum is facing $12.6 million in FBAR penalties. So it's a high stakes claim here. Okay, the next case. Oh, and all the cases and things that I'll be talking about today, just so everyone knows, I'll be linking those in the show notes. So everyone should have easy access to all this stuff. The next case is United States versus, and hopefully I'm saying this correctly, Sadem or Sadem. And in that case, that's a really interesting case because it's referencing the Timberly Hughes case, which I've talked about a couple times. That's the case that has had a lot of impact on how we do offshore voluntary disclosure or how we approach streamlined filing, willfulness versus non-willfulness. In the Hughes case, basically Hughes filed Schedule B for a couple years and didn't answer the questions in Part 3 correctly. The questions in Part 3, as a reminder, ask, do you have a foreign bank account? Yes or no. If you said yes, you do have foreign bank account or accounts, do you file the FBAR? Yes or no. And so if you don't answer those properly, but you did have foreign bank accounts and an FBAR filing requirement, then under the Hughes case, you're willful. But Hughes also said that if there is no Schedule B and there's no questions that are answered one way or another, then you're non-willful. So kind of like almost an objective test, right? Sadem basically had FBAR issues from 2013 to 2017, a dual U.S. Turkish citizen. And in that case, which is also kind of broken with Hughes, this is the second time I think this has occurred. They're basically saying, like, look, we're not going to go look at the Schedule B questions and how that was done on the tax return. We're going to let a jury decide whether the FBAR reporting failure is willful or non-willful. So I think that's a pretty big win. Hopefully that logic of thinking will continue and the Hughes case will be overridden and kind of forgotten to history. Because I think it's a very tough line to I think the IRS assumes everyone reads every single item of their tax return, every single nook and cranny, and they know all of it. That's simply not the case. I know a lot of clients that just they don't even know Schedule B Part 3 exists. I've opined upon this in blog posts. I think that the Schedule B Part 3 questions and the digital asset questions on page 1 of the 1040, which are kind of hidden, should all have a very, its own little schedule and form that everyone should be required to sign off on. It should be in 40-point font, and you should be required to read it and really kind of understand it before you move on in your tax return. But unfortunately, that is just not the case. Okay, so that's it for FBAR litigation. Let's move on to France, and then we'll back to IRS. So France is in a little bit of a pickle. They've got a $20 billion deficit, and on September 18th, there was an interview on BMF TV, and forgive my French. I'm now trying to speak. I was trying to speak Portuguese earlier. Now I'm going to go into French. But the Bank of France Governor François Villeroy de Galhau announced that France will need to raise taxes to overcome their $20 billion deficit. And Prime Minister Barnier has basically kicked off, how are we going to do this? And, fortunately for individuals, the focus right now is really on corporations. So they've introduced a potential what's called windfall profit tax on large corporations and stock buybacks. I'm not sure that's going to cure the full deficit amount, and so there may be some more movement there on French taxes being raised. I would refer everyone to a podcast I recently did with my colleague Delphine Parigi out of DPZ in Nice. She did a fantastic job talking about what's going on in France and what we can expect next out there. And we'll make sure to link that podcast in the show notes. Okay, IRS news. I got a couple different topics I want to talk about today with what's going on at the IRS. So first of all, the IRS is seeking comments. There's not a lot of time left on this. In fact, the time may be expired by the time this podcast comes out. But anytime the IRS seeks comments on something, I'm always telling there's been people I know that it affects to, hey, go out there and make some comments, talk about these forms. But specifically on three forms, 8621, which is your PFIC form, 8621A, which is your purging PFIC form, and Form 1116, which is your foreign tax credit form. So if you're a U.S. taxpayer and you have international or foreign source income that potentially has credits or PFIC issues, and just to kind of really quickly dumb down what is a PFIC, it's generally, for most folks, it's going to be a foreign mutual fund. And in my opinion, PFICs 8621, 8621A, probably the worst section of the Internal Revenue Code as far as tax ramifications. That's Internal Revenue Codes 1291 through 1298. Really bad news bears stuff. Those forms are not that easy to prepare or complete. Most DIY software, in fact, does not even have the option to fill out 8621, 8621A. So I think that there are a slew of comments that can be made to make those forms easier and more palatable to the average taxpayer. Secondarily, the IRS released a crowdfunding fact sheet, and there's a lot of confusion as to whether donations or quote unquote gifts made by crowdfunding are actual gifts or their income to the person receiving the money. And there's also some interesting issues with how the 1099K reporting is done for crowdfunding. So there's a fact sheet that was released in September for anyone that maybe has a crowdfund or perhaps maybe gave a large gift to a crowdfund and wants to understand how to do the reporting. I would tell you to go look at that fact sheet to make sure that you've got some guidance on that. On September 6th, the IRS, as they like to crow when they've done something right, they basically released kind of a, hey, look at what we did. They are continuing on the march to audit and squeeze uncollected revenue from high income, high net worth individuals. According to the September 6th publication or release, they've now collected $1.3 billion from 21,000 taxpayers that they've identified are delinquent in filing and or paying taxes. So the IRS doing their job to collect revenue. Okay, next topic is there's a case, and I'm going to do an entire podcast on this case. It's called the Fowler case, and it came along in 2020. And basically, there's a lot of hubbub going on right now about tax returns that are e-filed and then rejected by the IRS. For some way, shape, or form, the return doesn't get through the IRS system, and then the IRS looks at it as if it were never filed. And so eventually, when the taxpayer learns that they've got a tax return that was never processed or filed, and then they go to file it, there's a whole bunch of issues, especially if there's a balance due. There can be failure to file penalties, failure to pay penalties, all sorts of stuff that floats around in there. So if you look at the 2023 National Taxpayer Advocate Report, this is identified as a really big issue. And the Fowler case really kind of walks us through what to do here. There's a lot of commentary on Fowler right now. So eventually I'll follow back up and I'll do a podcast on this, and maybe I'll bring in a specialist to talk to us about how to approach this type of issue. But this goes back to a lot of comments that I tell a lot of clients, which is, go register for an IRS online account. Go check it regularly. It's kind of like going to the doctor. You want to get a good bill of health. You want to make sure nothing's out of whack. The IRS online account is not, there can be times where you go in and you check it. You're like, okay, there's no issues. But then maybe you get a letter and there's an issue. It's not 100% going to tell you always when something is wrong, but it's kind of a good thing to have and go look at quite regularly. And especially if there's an unfiled tax return, that should show very quickly. Okay, last two items on IRS news that I want to walk through. There are 3 new GAO, and GAO stands for Government Accountability Office. There's 3 new GAO reports that were issued in September. The first one on September 9th walks through IRS data warehouse security, which is not very good. And there were a lot of recommendations to improve that security in that report. There was a report issued on September 11th detailing the IRS modernization efforts. So if anyone is wondering where the IRS is at with their modernization efforts, and specifically going paperless starting in 2026, that's a fantastic report to kind of get your update on. And then lastly, there was a report on September 19th from the GAO on information returns related to digital assets in the gig economy. And so going back to my earlier comments about tax practitioners that need to understand the 1099-DA and 1099-K, I would tell you that if you want to really get into the weeds and understand those, that's a fantastic report. It kind of lays everything out for you and kind of makes you understand how those forms work. Okay, last thing is for folks that are maybe appealing an IRS decision. On September 18th, the IRS Independent Office of Appeals announced that they are going to use what's called a group mailbox, email mailbox, meaning that not necessarily that an individual taxpayer can email everyone in the Office of Appeals, but rather if there's someone working on a case in the Office of Appeals that's an IRS person and they have a question, they can send it to this group mailbox. This is my understanding. And then a lot of folks within the IRS Office of Appeals could respond back to that, maybe give guidance or help out. So kind of like almost like an office hours, mailbox there, if you will, as far as being able to gather information and respond back timely to taxpayers. All right, let's keep rolling. Let's talk about the state of Maryland here. So there's a really interesting case called the Cosgrove case in the state of Maryland in September. And Cosgrove basically argued that, I believe Cosgrove got a foreign earned income exclusion. And Cosgrove argued that Maryland should follow along with the federal return and should add back in the income. The court in this case ruled that the issue was moot because again, the state of Maryland, I think, just didn't want to deal with this. So they just said, look, we'll exempt the income or exclude the income, and the taxpayer received their refund. But the court, interestingly enough, said that the state's law is unclear on this issue. And I would agree. Maryland is really bad. It kind of gives some general comments about adding back in income exempt under federal law or under a treaty, but it doesn't really talk through the nuts and bolts of what that really means. And it's kind of like an open-ended thing. I know that Maryland now has private letter rulings, and I believe that process is free in Maryland where it's not free with the IRS. So that's an area that maybe if you have a question on, instead of taking it to a court case in Maryland, maybe you do a private letter ruling and share that with the class. Okay, Massachusetts. So we talked about the Brazilian tax amnesty program earlier. The state of Massachusetts announced its own tax amnesty program on September 19th. That will run from November 1st through December 30th, 2024. And there's a whole kind of rundown of who's eligible, who's not eligible to be able to get into the program. But if you do it, you can save on tax liabilities and penalties. And so if you have issues with the state of Maryland, now is the time. And my advice is always, if you're going to do an amnesty program, get a tax professional to help you out. Okay, moving on, state of New York. So state of New York, two issues to discuss with New York. So first off, there was a bill introduced on September 11th. It's New York S.9907. And this kind of follows along with some of the campaign promises by the presidential candidates. But basically, it creates an income tax deduction for cash tips. So it wouldn't exclude the income, but rather would create a deduction. So I guess if you get tips through a credit card, that would still be taxable in New York. But if someone gave you cash, that would be a deductible against your income. And if that bill goes through, it would go into effect in 2025. Secondarily, we've got a court case on September 20th in the matter of Bryant. Bryant basically said that, look, my income's not taxable in New York because I work remotely in another state. New York came back and hit him hard with, or this person hard with what's called the convenience of employer rule and said, look, you were working remotely because you chose to work remotely, not because you had to work remotely under the COVID-19 rules. Therefore, based off of the convenience of employer rule, your income is apportioned in New York and you owe us tax. My summary on this particular issue here is that you need to be very careful if you're a New York taxpayer as it relates to the convenience of employer rule. This is not a well-known rule, but it really hurts. And it can apply in a wide variety of situations for people that have ties to New York. So be careful with that one. Okay, Spain, this is the celebrity portion of the podcast today. I just wanted to quickly summarize. So for those that do not know, Shakira, the singer Shakira, was indicted for fraud in Spain in 2018. I believe Shakira was dating a soccer or football player. I believe that person was a U.S. person, but that was playing in Spain. So she was kind of in and out of Spain and basically said that, hey, look, I'm not a Spanish tax resident. I'm a resident of the Bahamas. Spain said, no, you're a resident of Spain. We can prove it. They did prove it, or they did force Shakira to settle the matter, and she settled by paying Spain 22 million euro in 2023. And here in 2024, on September 4th, she basically sent a letter was published by El Mundo, which is a Madrid newspaper. And Shakira kind of walked through the timeline of everything that was happening, sharing a lot of personal details and her dealings with the Spanish tax authorities. And she said, quote unquote, it was the equivalent to public burning at the stake. So for those folks that may have issues with the Spanish tax authorities, tread lightly. It looks like they are tough. Okay, Switzerland. This is the last country update for the podcast today. So Switzerland, just kind of want to walk through this one real quick. On September 17th, Swiss regulators issued roughly a $15 million fine against Mirabad. Mirabad, I believe, is a brokerage firm located in Geneva. And it's related to the investigation for Robert Brockman. Brockman has the largest U.S. tax fraud case in history, so he wins that award. Also the subject of a lot of talk in the U.S. Senate by the Democrats and Ron Wyden. Basically, Brockman held $1.7 billion in assets with Mirabad through a wide variety of complex structures and companies. And his total scheme over a 20-year period, I think, led to a $2.7 billion income tax loss. So big issue there coming out of Switzerland. It seems like the hits never stop coming when it comes to folks hiding funds out in Switzerland. And the last topic for today, and this is going to be a shorter podcast than normal, which I'm very proud of. A lot of times my podcasts go a lot longer than I want them to go, but today we're going to get to probably under 35 minutes. But the last thing to talk about is the U.S. and Romania potentially have a brand new totalization agreement or social security agreement, which is fantastic. President Joe Biden on September 12th transmitted that to Congress. And assuming nothing goes wrong, it should be entered into force in 2025. So that should be super helpful. So for example, if I'm a U.S. person and I'm self-employed in Romania, in 2025, I may be able to get a totalization certificate so I don't have to pay U.S. self-employment tax, assuming I'm contributing to the Romanian social safety net out there, and then vice versa. So that would be very, very helpful for mitigation of double taxation for Social Security taxes. And with that, I am done with the podcast for today. I thank you for your attendance, and hopefully you walked away with a couple things that will help you along your day.
You've been tuning in to the Essential Tax Podcast with your host, Mishkin Santa. You can find this show on all the major platforms, including YouTube, LinkedIn, Apple Podcast, Spotify, and on our website, thewolfgroup.com. Thank you for your positive reviews, comments, questions, and for sharing this show with others.